Hello and welcome to Chapter 27 Screencast, the basic tools of finance. Now this is a kind of a strange chapter. There's really 3 bits to it and they don't naturally flow, so we're just going to do the 3 bits. It's actually relatively short. So the first bit relates to what we call present value, and this is a really important concept in finance. It studies how people make decisions, the allocation of resources over time, and the handling of risk. Basically, that's what the chapter is all about. But this concept of present value is used throughout a lot of finance. What it relates to is basically how much future streams of income or payments that are going to be made in the future are worth today. And of course, if you kept money today into the future, it would be worth the same amount if you just stuffed it under your mattress. But if you put it in a bank account, it gains interest, and that interest compounds. And as it compounds, obviously you have more money. So what present value asks is the opposite. In other words, if you have a certain amount of money in an account in the future, how much is that worth today? And so you need an interest rate to sort that out, obviously, and it's really the opposite of compounding. That's really what it is. So the future value is the amount of money that you have in the future. So in other words, if you put $100 into an account, it yields or it pays interest at 10%. It means next year you're going to have $110. And that's compounding, because after that, if it still gives you 10%, you'll have not just 120, you'd have 121, because 10% of 110 is $11. So that's why it compounds over time. And the reason why that is because interest that's earned remains in your bank account. Of course, no bank accounts actually pay 10% these days. They pay a lot lower. But there have been times in the past when bank accounts have paid decent amounts. So here's an example using some math. What's the value of something in the future? Well, if the present value is 100, what's its future value? Well, if you have an interest rate R, then the $100, and that's the first bullet point there, is worth 1 plus R, 1 plus the interest rate times 100 after year 1. And then after year 2, it's 1 plus R times 1 plus R times the 100, so it's 1 plus R squared. And 2 years, that's the second bullet point, etc., etc. So if you're looking at n years, it would be 1 plus R to the n times 100. Now, all we do is we work that backwards. So if you have $200 n years into the future, and your interest rate is still that little r, then the present value, how much that's actually worth now, is $200, but instead of multiplying by 1 plus r to the n, as you would do if you're compounding, remember you're going from the future back to the present, so you divide by 1 plus r to the n. And that, getting the present value, to get the present value, the way in which you do that is called discounting the future value. So instead of compounding the present value into the future, you discount the future value to the present. And here's the general formula for discounting. The present value is just the amount in the future, x, divided by 1 plus r to the n, instead of multiplying, which would be compounding. Now the second part of this chapter relates to risk. And really what a lot of finance is about managing the risk that you have in any investments that you have. Here we're using the term investments in the common way in which it's used in finance to mean, any assets that you have, financial assets usually. So, there's what finance people call the risk-reward trade-off. In other words, if you take more risks, more likely you're going to get possibly more rewards. Of course, you could get more losses as well. And people who basically do not like taking risks, we call risk averse. Of course, the opposite of that is someone who likes taking risks. They're called risk lovers. And we relate in economics and finance, we relate this to utility. That is the satisfaction that someone gets out of something. And that's the term we use for it in microeconomics. And we can basically try and, in theory anyway, say how much satisfaction people have with a certain amount of wealth. Now, interestingly, the more wealth you have, in fact, the less marginal utility you get. So in other words, what this means is that if you're poor and you earn an extra $1, it means that that extra $1 is much more valuable to you, so you get much more utility out of it, much more satisfaction out of it, than if you're rich. Say you're a millionaire and you earn an extra $1. Why? Because obviously to the poorer person, the $1 is worth a lot more in terms of the percentage of their income than a rich person. Than for a rich person. For a rich person, an extra $1 is just, a millionth more in their income. So we also know that, and so we call that diminishing. Basically, it's diminishing returns. But we have a special term for it when we're looking at utility functions, and we call that a diminishing marginal utility. And it looks like the curve that we saw with diminishing returns when we were doing growth, economic growth. We can draw a similar kind of function for wealth. In other words, for someone who's poor, the utility, the extra satisfaction they get from an extra $1, or the loss of satisfaction in this case, from losing money, is going to be greater than the satisfaction gained from gaining money. So that is, and this is what's shown in this diagram, if you're at a certain point of wealth, that's that kind of middle point there, you gain money, well, that's going to give you less utility than well, it's going to give you more utility. I mean, it's going to give you satisfaction, obviously, but you would be more upset if you lost 1,000 than if you gained 1,000. That's basically what that says. That figure says. Now, of course, you can mitigate, or you can kind of offset some of this risk by basically buying insurance. So when a person faces a risk, they can insure against that risk, and to do that they obviously pay a premium to an insurance company, and the insurance company accepts all or part of the risk. If they accept part of the risk, then of course there's usually a deductible. The deductible means that you are going to have to take some cost share for the damage or for the event that's happened. And the insurance contract is that you get, when you're buying auto insurance or health insurance, is basically a gamble for the company that's issuing it. You pay the insurance premium, and basically you're transferring the risk to the insurance company. And what do you receive in return for the payment for the insurance? Well, you receive peace of mind. So, what's the point of insurance? Well, it doesn't eliminate the risks. It doesn't eliminate the possibility that you're going to have a car wreck or that you're going to get sick with health insurance, but it spreads the risks around more efficiently. Now, there are some problems with insurance markets. The problems are problems of what we call adverse selection and moral hazard. And these are both problems, by the way, that we call asymmetric information. In other words, problems which the insurance company usually faces when selling insurance. What are the two problems? Well, the first problem is when the insurance company sells the insurance, of course, the person who's most likely to suffer that type of damage or event or sickness or whatever you're insuring against is the person most likely to come forward and ask for the insurance. That's called adverse selection. After you've bought the insurance, of course, you feel safer. You have peace of mind, so you're more likely to take or to behave in a risky manner or riskier manner than you would have without the insurance. So what we find is that people who have auto insurance are less likely to drive as safely, or they'll be less likely to worry about where they park their vehicles, or less likely to worry about their health if they've got health insurance, because they know they're covered for certain events. That's called moral hazard. Now, the third part of this is about, as I said, it's a weird chapter. The third part of this is about portfolios of investments, and it's about managing risk. Once again, you've hopefully understood the concept of risk, but managing risk when you've got a portfolio of investments here being, of course, purchases of paper assets, financial assets. There's an age-old rule that says the more diversified you are, the less risk you carry. So by diversifying a portfolio, for example, in other words, by holding lots of different stocks or different shares or different financial assets, you have less risk of losing a lot of money, because of course you have a lot more smaller smaller amount in each stock, or and a lot more stocks spread across a whole bunch of different companies. In other words, the key message here is it's better not to put all your eggs in one basket. How do we measure the risk when we're looking at a portfolio of investments? Well, we look at the statistical measure, which is called the standard deviation. And I'm sure most of you have covered this in statistics. It measures really the volatility of any variable. So when we're looking at, say, a portfolio of stocks, which most of you are going to have at some point in your lives, the risk of the portfolio depends on how spread out it is across a whole group of stocks. And we can measure the riskiness in any stock portfolio by looking over time at the standard deviation of the portfolio, how much it goes up and down. Good portfolios tend to have a decent return, so they're giving you money back year after year, but at the same time they're not going up and down a lot. So the higher the standard of deviation is, the riskier the portfolio. So if we were to look at the number of stocks in the portfolio, that's on the horizontal axis in this diagram, and we're to look at the risk, the standard deviation of a portfolio return. If you had one stock, so that's right at the left-hand side of this diagram, you can see that the standard deviation is pretty high. The more stocks you add, the more the portfolio falls. Of course, you're not going to get rid of all risk. There's always going to be risk, and that risk usually comes from the business cycle, I might say, and the business cycle being the ups and downs in the economy. But you will certainly minimize it. You'll reduce it. So when we're looking at diversification, one of the really good things about it is you eliminate firm-specific risk. In other words, if you have all your portfolio invested in one stock, you could be facing a big problem. And what's that problem? Well, something could happen to that company. Of course, the company could grow fantastically and all the rest of it, but it could also have big problems. And we've seen that with stocks lately. For example, Whole Foods, the organic grocer, just fell 20% in the stock market yesterday. We've had other events like with BP, when we had the Deepwater Horizon oil rig catch on fire and then explode, and then BP had to make billions of dollars of compensation payments. Obviously the value of the stock fell because it was going to have to use its assets to basically pay off people living in the Gulf states. So if anyone was invested all in BP, they would have not been happy. So the key thing is to diversify. to get rid of that firm specific risk. Of course, you're not going to get rid of the market risk, and that, as I said, is mostly related to the business cycle. In fact, the ups and downs in any stock portfolio, the 60% of it is due to what happens in the business cycle. Nevertheless, you can certainly help yourself when you do get a stock portfolio going by diversifying as much as possible. And that means, by the way, not just diversifying in terms of US companies, but diversifying internationally as well. So what's the trade-off between risk and return? I said earlier that you can opt for more risk, but of course if you opt for more risk, usually it's because you're hoping for a better return. So, there are basically two types of assets. There's a diversified group that might give you an 8% return, but a 20% standard deviation, so there's some risk attached to it. Or maybe there's a safe alternative, a safe group, if you like, that gives you a lower return, just a 3% return, but no risk. Which would you go with? Well, that's a problem that economists study, and of course it depends on how risk averse you are. In other words, how much weight you put on avoiding risk. So the more a person puts into stocks, usually the greater the risk and the greater the return. And that's why most portfolio advisors tell you should also have bonds as well, because bonds are usually a lot less riskier over the long run, but they don't pay as high a return. So here's the trade-off between risk and return. This is illustrative, of course. This is not actual figures. But you can see as the risk goes up on the horizontal axis, you can see that the return potentially goes up the more stocks you have. And because stocks are inherently more risky than bonds. Now, when you look at stocks, you want to try and value them. You want to try and look at how much the company's really worth. And one way of doing this is to, and we've seen how this works with a balance sheet, by the way, when we looked at assets and liabilities. For a bank, for instance, we said the value of the bank was what's left over when we've taken their assets and we subtract the liabilities that they owe other people. What's left over is the value of the shares. So one way of looking at this is to, well, first of all, you've got to study the company's accounting statements and their future prospects, because you're not going to invest in the company that you don't think is going to do well in the future. But to determine the value, basically, you look at the price and the value of the company. So if the value of the company is greater than the worth of the stock, if you like, then it's clearly undervalued. And there's lots of investors, by the way, who are professional investors, people like Warren Buffett. This is all they do. They look at companies and they try and value them, and then they look at the prices. And if the price is less than what they think is the value, and usually they have to do a present value calculation here, because they've got to try and value the future profits of the company, then they buy it because it's undervalued. And that's what Warren Buffett does. That's his favorite way of investing. An overvalued stock is where price can be greater than value. Now, a lot of these kind of stocks are growing incredibly fast. So you'd ask, why would anyone buy an overvalued stock? Well, a stock like Twitter has been overvalued when it first had its IPO, its initial public offering, when it was first offered to the general public. Why? Because people thought it was going to grow very quickly. Now, since it had its IPO, it revealed that it wasn't growing that quickly. It was having some problems. So in other words, its value was basically less than the price. So what happens to the price? Well, the price is going to fall, obviously. A fairly valued stock is where the price and the value are roughly equal. So what a lot of portfolio managers do is that they basically do all the research for you. Of course, you could do it by yourself if you want, but do it for you, and then they pick stocks for you, and put them into what we call a mutual fund. A mutual fund is basically a basket of stocks which you buy, and someone's already done the research for you, basically Wall Street analysts usually. Now, mutual funds are available for 401ks, for IRAs. 401ks are what you get as a retirement fund, and that's a 401k. And IRAs are something you can do by yourself. For most of you, it's around $6,000 a year you can put away. You can buy mutual funds for those as well, or you can buy individual stocks usually. So here's some economic theory, finance theory that goes with this. There is the view that asset prices are efficient because markets soak up all the information out there, and people trade on that, so that the price in the market will give you exactly what the value should be. We call that the efficient markets hypothesis. So the asset prices reflect all the publicly available information. Why? Because there's a lot of people involved in buying and selling and making decisions about those stocks, and so each company is basically rated by those analysts. Now, not all economists agree with this. A lot of people think that those people who manage companies don't know what they're doing. In fact, interestingly, there was a study by researchers at the University of Toronto where they used a chimpanzee, a monkey basically, to pick stocks, and the portfolio of stocks performed better than any of the analysts in that particular year. So this is, if you need proof against the efficient markets hypothesis, that was pretty good proof. But a lot of people still think that stock markets exhibit this informational efficiency in the sense that they value things properly, and they rationally reflect all the available information. Basically, they incorporate, they accept all the news on any stock, on any company, and put that into the price of the company. So if that's the case, then economists were thinking, well, or the way economists think is, well, is this news consistent or is it random? Could it be up or could it be down? Well, oftentimes if it's consistent, then we should be able to forecast it. And one of the things we can't do is we can't tend to forecast how companies do. That's why we have them releasing their quarterly reports, their quarterly information about how they're doing. So, if that's the case, then if the information's random, then surely the movement in the stock should be random. So in other words, it should have a probability of going up about the same as the probability going down. In other words, it should be impossible to predict which way a stock is moving from the information that's in the markets. But this is called the efficient markets hypothesis. So it's really a theory about how financial markets work. We know that it's not completely true. Why? Because there are some very good portfolio managers who manage to outperform the market. So if the stock market index, which is a weighted index of all the funds, goes up by 3%, these managers tend to do better. So, and consistently better. So that would tend to suggest that the efficient markets hypothesis is not true. The evidence on stock prices, though, is that they aren't a random walk. They're not random, but they're not far from being random. So it's not completely true, but it's quite close to being true. And a lot of people recommend that when you do get a retirement fund or whatever, you buy a mutual fund that basically has all the stocks in the stock market index. And the two stock market indexes that you see in the US are the Dow Jones, you're probably familiar with that, and the S&P 500, the 500 biggest companies in the US. These active funds, and that's what I talked about before when I said that some managers do well and they tend to outperform the market. they like to just buy the best, what they call the best of breed. In other words, in any given sector, they'll concentrate on what they think is the best stock. And hopefully that does well over time. What's interesting though is that there are some funds that do better over time. But if you take all of the funds out there, they don't. The index funds outperform. So the ones that are just based on the weighted average of all the stocks are better than the ones that are managed on average. And these active portfolio managers, one of the problems with them is they charge fees. I mean, obviously with an index fund that's just the weighted average of all the stocks, the fees are going to be very low because there's no one actually managing them. They're just whatever that weighted index is. Now, when you have a managed fund, what he calls here an active portfolio manager, they are buying and selling stocks for you according to what they think will increase their fund more than the market will go up. They usually trade more frequently. Obviously they incur trading costs in doing that, so the fees for those funds are usually higher. But the interesting thing is, and I've said this already, some do beat the market, but only 16% of managers consistently beat the market. So if you do your own investing, in other words, choose your own mutual funds, then you've got to do the homework to decide which mutual funds are the ones that should go into your portfolio if you have any chance of beating the market. Okay, I think I've talked about the first bullet point here. The second bullet point, fluctuations in stock prices. You know, and we've been seeing this lately, the stock market is very psychological. If it thinks that a certain class of shares, so for instance all the technology shares recently, at this time of speaking anyway, have all been pummeled in the stock market, including Facebook and all those shares. They've all been beaten down. Why? Because the people who trade in the stock market don't think that they're concentrated on giving a profit for their shareholders. And the feeling at the moment, anyway, is that the market participants want to make sure that their companies are making profits so that they get dividends. So we've seen that trend in the last few weeks going on. Sometimes you get a whole class of assets, and we've seen this lately in the biotech stocks, where there was a kind of a frenzy. And the price of these stocks got bid up way above their fundamental value, and you get what we call a speculative bubble, where suddenly the bubble bursts and everyone starts to sell like crazy and the prices collapse. And you know, really, and that's one of the reasons why, by the way, suddenly that people who trade in stocks want good old stocks that may not be of companies that may not be growing that fast, but they give a good solid return and they're making a profit, because many of the companies that are what we call high growth stocks like Amazon and like Tesla, they're not making a profit yet. Tesla, by the way, produces electric cars. I hope you're aware of that. And I think everyone knows what Amazon does. I hope you do. But once again, Amazon has not made a profit. It doesn't seem to bother Amazon, but it clearly bothers the stock market because their stock has collapsed recently. So, what causes these speculative bubbles to appear? Well, one of the things is, if these companies are growing very fast and they don't seem to be worried about making a profit right now. And many companies are like that. They say, why should we worry about making a profit? We should be worried about growing our company as fast as we can, as Amazon has done. So, the value of the stock also depends on those future dividend payments, and the fact that Amazon doesn't pay a dividend obviously means it's not in vogue right now. It's not very popular right now. So, there's a big debate that goes on about the frequency and importance of departures from rational pricing. In other words, when we get these bubbles, because because these bubbles aren't really logical, and it's very hard to explain them. What some people call market irrationality. So, the efficient markets hypothesis, we know it doesn't hold completely. So it's really very difficult to know what the appropriate stock price is that you should be paying for something. There are some measures that you can find out, just by Googling. So one is earnings per share. That is a way of comparing companies, and there's other methods as well.